Listen to me very carefully, because what I am about to tell you is the kind of information that separates generational wealth builders from the people who always seem to show up a day late and a dollar short. I have spent over 40 years on Wall Street. I have sat in the rooms at JP Morgan where decisions get made that move billions of dollars across global markets. And in all of those decades, I have rarely seen a setup quite like this one. A company that was facing what most people believe to be a death sentence, a full-scale legal assault from one of the largest pharmaceutical corporations on planet Earth, and instead of being destroyed by it, they turned that enemy into a partner. The stock exploded nearly 47% in a single week, and yet, even after that move, there is a very real case to be made that this company is still cheap. Now I know what you're thinking. Marcus, how can something that just ran 47% still be cheap? That is exactly what I am going to break down for you today. The company is Hims & Hers Health, trading under the ticker symbol HIMS. And before we get into the meat of this, I need you to do something for me right now. Subscribe to Invest with Marcus and turn on that notification bell. I am not some influencer chasing clicks. I am a banking veteran who spent his career building wealth for institutions, and now I am giving that same caliber of analysis to you for free. Hit subscribe so you never miss a move. And drop a comment below telling me whether you have been watching Hims or if this is your first time hearing about it. Let us build this community together. Now let me set the stage for you, because context is everything. In my decades at the major firms, one of the first things we taught young analysts was to never look at a stock in isolation. You always need to understand the macro environment that stock is operating inside of. So let me give you the landscape. We are sitting in an environment where the Federal Reserve has been cutting interest rates. Inflation, while cooling on paper, is still running hot enough that consumers feel the squeeze every single day. Healthcare costs in America are completely out of control. The average American pays more for prescription medications than citizens of any other developed nation on Earth. And here is where it gets interesting. There is a massive, unstoppable consumer trend happening right now. Tens of millions of Americans are demanding access to affordable healthcare through their phones. Telehealth is not a fad. It is the future. And at the center of that future sits a company that has quietly built one of the most powerful direct-to-consumer health platforms in the country. That company is Hims & Hers. Let me tell you the story of what just happened, because it reads like something out of a Hollywood script. Back in early February 2026, Hims & Hers made an aggressive move. They announced they were going to sell a compounded version of Novo Nordisk's blockbuster weight loss drug, Wegovy, at a fraction of the price. We are talking about $49 a month compared to the $149 Novo charges for the branded version. Now, Novo Nordisk is not some small company you can push around. This is a pharmaceutical titan worth hundreds of billions of dollars, and they came back swinging hard. They filed a patent infringement lawsuit against Hims & Hers. Analysts panicked. Citi slashed their price target. Deutsche Bank cut theirs from $42 all the way down to $31. TD Cowen dropped to $20. The stock was already down over 70% from its 52-week high of $70. The narrative on Wall Street was simple. Hims & Hers is finished. The GLP-1 gravy train is over. Game over. But here is what Wall Street did not understand, and what I saw from decades of watching these exact situations play out at the institutional level. When you have a company with a real platform, real customers, real revenue growth, and a real strategic value proposition, the outcome of a legal battle is not always destruction. Sometimes it is partnership. On March 9, 2026, the news broke that completely rewrote the narrative. Novo Nordisk dropped the lawsuit. Not only that, they announced a full strategic partnership with Hims & Hers to sell branded Ozempic and Wegovy directly through the Hims platform. Read that again. The company that was trying to destroy Hims & Hers just 3 weeks earlier decided to become their business partner. Novo Nordisk's CEO publicly confirmed the deal and said he does not foresee any reason to refile the lawsuit. In exchange, Hims agreed to stop advertising compounded GLP-1 medications and shift its weight loss business toward FDA-approved branded treatments. Existing patients on compounded semaglutide will have the option to transition to branded medications when their providers determine it is clinically appropriate. The stock surged over 40% on the day of the announcement. Trading volume hit 168 million shares, which was roughly 557% above the 3-month average. In a single week, shares climbed approximately 47%. And yet, even after all of that, the stock is still sitting around $26, which is more than 60% below its 52-week high. That gap is your opportunity. Now let me put on my institutional analyst hat and walk you through the fundamentals, because that is where real conviction gets built. In my years at JP Morgan, we never bought a stock because of a headline. We bought stocks because the numbers told a story that the market had not fully appreciated yet. So let us look at the numbers for Hims and Hers. Full year 2024 revenue came in at $148 billion, up 69% year over year. The company was profitable, generating $126 million in net income and $177 million in adjusted EBITDA. That alone makes this a rare breed. Most high-growth companies at this stage are burning cash. Hims and Hers is not. They are making money while growing at 69%. Moving into 2025, the growth actually accelerated. First quarter revenue was $586 million, up 111% year over year, with $49.5 million in net income. Second quarter came in at $545 million, up 73%. Third quarter was nearly $600 million, up 49%. Fourth quarter revenue hit $618 million. The full year 2025 number came in around $2.35 billion, and management is guiding for $2.7 billion to $2.9 billion in revenue for 2026. The subscriber base has grown to approximately 2.5 million people, up over 20% year over year. Gross margins are sitting at 73.8%, which is exceptional, and the company has set a long-term target of $6.5 billion in revenue and $1.3 billion in adjusted EBITDA by 2030. If they hit that target, you are looking at a company that would be generating more cash flow than most mid-cap companies in the S&P 500. Now here is the part most people completely miss. And this is where my experience in institutional banking gives me a different perspective. When I was managing portfolios for high net worth clients, we always looked for what we called event-driven re-ratings. This is when a single catalyst fundamentally changes the risk profile of a company, causing the market to re-rate the entire business. The Novo Nordisk partnership is exactly that kind of event. Before this deal, the single biggest risk hanging over Hims and Hers was legal and regulatory uncertainty around compounded GLP-1 drugs. That was the bear case. That was the reason shorts were piling in. That was the reason analysts were cutting targets left and right. And in one single announcement, that entire risk was eliminated. Not reduced, eliminated. The company that was the source of the legal threat is now the company supplying product to the Hims platform. Think about what that means from a risk-reward standpoint. The downside scenario just got dramatically smaller, while the upside scenario got dramatically larger. The stock is currently trading at roughly 20 times forward earnings. For a company growing revenue at 40 to 50% per year, with 74% gross margins and a pathway to $6.5 billion in revenue, a 20 times forward multiple is not expensive. In fact, in my professional opinion, it is objectively cheap relative to the growth trajectory. But Marcus, I can hear some of you asking, what about the risks? Let me give you straight talk, because that is what I do. I am not here to sell you a fantasy. First, margins on branded GLP-1 medications will almost certainly be lower than what Hims was generating on compounded versions. The company is going to have to prove it can generate strong profitability selling branded products at competitive prices. Second, Novo Nordisk explicitly stated they reserve the right to refile the lawsuit if HIMS violates the terms of the agreement. That means the company has to operate within strict boundaries going forward. Third, the weight loss drug market is about to get more competitive. Eli Lilly is expected to launch an oral GLP-1 medication later this year, and other companies are entering the space. HIMS needs to continue differentiating its platform through convenience, personalization, and customer experience. Fourth, the stock is still extremely volatile. It has had 77 moves greater than 5% over the past year alone. If you cannot stomach that kind of volatility, this is not the stock for you. But here is the counterpoint, and this is what separates professional investors from amateur ones. The reason Novo Nordisk chose to partner with HIMS instead of simply crushing them in court tells you something critical about the platform. HIMS has 2.5 million subscribers. They have built the largest direct-to-consumer telehealth platform in the United States. Novo realized it was more profitable to use that distribution network than to destroy it. When your enemy decides you are more valuable as a partner than as a target, that is the strongest validation a business can receive. Now I want to address something that my community has been asking about, and that is the bigger picture. This is not just a story about one company and one partnership. This is a story about the transformation of American healthcare. In my 40 years in banking, I have watched industry after industry get disrupted. Music, media, retail, travel, banking itself. And every single time, the companies that built the platform, the ones that owned the consumer relationship, ended up being the biggest winners. Amazon did not just sell books. They built a platform. Netflix did not just mail DVDs. They built a platform. HIMS and Hers is building the healthcare platform for the next generation of Americans. They started with hair loss and sexual health. They expanded into skincare, mental health, and dermatology. They moved into weight loss and GLP-1 medications. And now they are positioning themselves as what their CEO called a marketplace of brands, a platform where consumers can access a wide range of FDA-approved treatments across multiple specialties. The company is also expanding internationally into the UK, Canada, Germany, France, Spain, and other markets. If you understand platform economics, you understand that once a platform achieves critical mass with consumers, it becomes incredibly valuable to every supplier in the ecosystem. Novo Nordisk partnering with HIMS is proof of that dynamic playing out in real time. Let me also talk about what this means for the speculative crowd, because I know some of you are always chasing the next quick hit. I spent 40 years watching people blow up their portfolios by gambling on garbage companies with no revenue, no earnings, and no competitive advantage. They buy a stock because someone on social media told them it was going to the moon, and 6 months later they are sitting on a 90% loss wondering what happened. HIMS and Hers is not that kind of play. This is a real company with $235 billion in revenue, positive net income, 74% gross margins, and a massive addressable market. The GLP-1 weight loss drug market alone is projected to reach over $100 billion by 2030, and HIMS just became one of the primary distribution channels for the biggest brand name in that market. This is not speculation. This is a calculated, fundamentals-driven thesis backed by real numbers and real catalysts. The kind of investment that institutions build positions in, not the kind they run from. So here is my bottom line, and I want you to think about this carefully. HIMS and Hers Health went through a trial by fire. They were sued by one of the most powerful pharmaceutical companies in the world. The market priced in the worst-case scenario, sending the stock down over 70% from its highs. And then, the worst-case scenario did not just get avoided. It got reversed. The enemy became the partner. The lawsuit became a distribution deal. And the stock, even after its massive rally, is still sitting more than 60% below where it was trading less than a year ago. In my decades of experience, some of the best investments I have ever seen came from exactly this kind of setup. A company that gets punished for a risk that ultimately gets resolved in a way that makes the business stronger than it was before the crisis began. That is, hims and hers right now. Do your own research. Understand the risks I laid out. Size your position based on your personal risk tolerance and financial situation. But do not ignore what is happening right in front of you. The market rewards those who do the work, who see the story before it becomes obvious, and who have the conviction to act when the opportunity presents itself. If this breakdown helped you see hims and hers in a new light, I need you to do 2 things for me. First, smash that like button so this reaches more people in our community who need to hear it. Second, drop a comment below and tell me your honest take. Do you think hims can get back to its all-time highs? What is your biggest concern? I read every single comment, and your perspective helps shape the analysis I bring to you every single week. And if you are not yet subscribed to Invest with Marcus, what are you waiting for? This is the channel where a 40-year banking veteran gives you institutional-grade analysis without the Wall Street price tag. Subscribe, hit that notification bell, and let us keep building generational wealth together. I will see you in the next one.